Welcome. In this video, has XCN coin started a rally? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When looking at the chart as a whole, it becomes evident that the market structure is clearly shaped within the framework of the Elliott wave theory. According to this theory, markets move based on certain psychological cycles and behavioral patterns, which typically consist of 5 main wave structures: 3 impulsive, trend-driving waves, and 2 corrective ones. These structures play a significant role in helping investors interpret market behavior and predict the potential direction of price movements. The current chart structure indicates that the second corrective wave has been completed, and the price is now entering the third major impulsive wave. In Elliott wave theory, this third wave is considered one of the most critical, as it typically represents the strongest, longest, and sharpest movements. This is because, at this stage, the majority of market participants are convinced of the trend's direction and position themselves accordingly. As a result, prices tend to rise much more rapidly and decisively compared to previous waves. The third wave usually operates with higher volume and stronger momentum compared to the first wave. When measured using commonly used Fibonacci extension levels in technical analysis, the minimum target for this wave is generally the 1/618 Fibonacci level. However, due to market enthusiasm and the impact of a strong trend, it is common for this level to be exceeded. Especially in speculative assets, the third wave can sometimes extend to higher levels such as 2/272 or even 2/618. This shows that the third wave has the potential to offer investors the greatest returns. Given that the price has completed the second corrective wave and is now entering a new upward impulse, it can clearly be observed that an upward trend has resumed in the chart structure. Technically, this points to a period where buying strategies will come to the forefront and market optimism will increase. During this wave, investor confidence grows, FOMO, fear of missing out, becomes widespread, and trading volume rises significantly. This contributes to stronger upward price movements. Another important element to monitor during this phase is whether higher highs and higher lows are forming. Throughout the third wave, the price typically makes continuous higher highs and higher lows, displaying a classic bull trend. As long as this structure remains intact, the upward trend is expected to continue. However, sharp pullbacks may also occur during this process. These retracements are usually minor corrections seen in the subwaves of the third wave and do not alter the main trend direction. In addition, when determining the targets of the third wave, one should not focus solely on the 1.618 or 2.272 Fibonacci levels. Previous resistance zones, psychological price levels, and historically significant horizontal levels should also be considered. If these levels coincide with the third wave targets, they can be viewed as areas where the price might initially pause or experience short-term profit-taking. This implies that investors should exercise caution around such zones. In Elliott theory, the third wave must never be the shortest impulsive wave. This means that technically, it should be longer than either the first or the fifth wave. If the third wave is too short, it contradicts the Elliott framework and calls for a reevaluation of the scenario. Therefore, it is essential to closely monitor chart patterns and price behavior throughout the third wave. In conclusion, based on the analyzed market structure, the second corrective wave has been completed, and the market has now entered the third impulsive wave. This phase is one of the strongest, most directional, and potentially most profitable parts of the Elliott wave theory for investors. But we can't rely on Elliott wave analysis alone. Let's take a look at other metrics as well. Stay tuned. When the chart is examined in detail, it can be observed that an inverse head and shoulders, IH and S pattern, which is frequently encountered in classical technical analysis and holds significant importance among trend reversal signals, has emerged in the market structure. This pattern is generally considered a strong signal that the current downtrend is ending and a new upward trend may begin. The inverse head and shoulders pattern is closely followed by investors as one of the most effective and reliable reversal patterns in technical analysis. The basic structure of the IH and S pattern consists of 3 main components: 2 shoulders and a head between them. First, the market price experiences a decline, followed by a slight upward movement encountering short-term resistance. Then, the price drops again to form a deeper low, which is called the head. After this, the price rises once more but fails to hold above the shoulder level and falls again. The second shoulder, which forms at this stage, is generally symmetrical to or slightly lower than the first shoulder. Currently, the price appears to be in the process of forming the final shoulder, which is one of the clearest indicators that the pattern is nearing completion. One of the most critical elements of the IH&S pattern from a technical perspective is the neckline, which is a horizontal or slightly sloped resistance level. This line connects the peaks of the shoulders and the head. A breakout above this neckline confirms the completion of the pattern and signals a trend reversal. The price is currently approaching this neckline and appears to be on the verge of breaking above it. This movement is one of the strongest signs of a potential upward trend. In technical analysis, the most commonly used price projection method for the IH&S pattern involves estimating the maximum price target by measuring the vertical distance between the head and the neckline. This distance gives an approximate target for how far the price may move upward after breaking the neckline. For example, if the distance between the head and the neckline is 10 units, then the theoretical price target would be an increase of 10 units above the neckline after the breakout. This target serves as both a take-profit level and a potential upper boundary for market movement from the investor's perspective. The fact that the price is currently in the process of forming the final shoulder is a strong indication that the pattern is nearly complete. This suggests that the market is preparing for a reversal and that upward momentum could increase in the near term. This pattern, when supported by technical analysis tools and accompanied by rising volume, tends to gain strong bullish momentum. In IH&S formations, trading volume typically increases during the breakout, as market participants recognize the trend reversal and quickly reposition themselves for the upward movement. Additionally, the IH&S pattern reflects investor psychology quite well. During the first shoulder and head phases, market participants are generally influenced by the downtrend and selling pressure dominates. However, during the formation of the final shoulder, especially as support levels are tested, buyers begin to re-enter the market and selling pressure diminishes. This psychological shift allows the market to reverse direction once the pattern is completed. Technically, for the IH&S pattern to be considered valid, a meaningful and strong close above the neckline must occur. This close is crucial for investors to confirm the trend reversal and initiate new positions. After such a breakout, the price is expected to move upward by at least the depth of the head. However, in some cases, when the price reaches the target zone, partial pullbacks may occur due to profit-taking. These pullbacks do not weaken the pattern but are rather seen as healthy corrections. MACD, the Moving Averages Convergence and Divergence Indicator, is one of the most effective tools used in the world of technical analysis to understand the momentum of price movements and the direction of the trend. This indicator is widely favored, especially for balancing the forces of buyers and sellers in the market and spotting potential trend reversals. On the chart, the MACD lines are currently struggling to hold above the zero line, which is a critical threshold level. The zero line is a very important reference point for the MACD, as its presence above or below this line directly affects the overall momentum of the market and the direction of the trend. Above the zero line is usually considered a sign of positive momentum and an uptrend, while below it is seen as an indicator of negative momentum and a downtrend. MACD lines go up, price goes up. Yes friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.